Hello and greetings. So this is a continuation from my other video, but basically the reason why I did this tutorial, I wanted to show you live, as it is happening because right now in New York time, this is 9 minutes past one. So I used the TradingView platform that I said. So a couple of things to have in mind. Typically I trade on a 1 minute chart. In other ways, each candle here that you see, it shows what happened into the price action in 1 minute. But this is an ETF SPY which I trade. So basically, it's an exchange traded fund that tracks the S&P 500 index. So what I then do is I do my charting, and the most important thing, like just to give you an example here, today I woke up around 5:40 my time, Pacific Standard Time, and I did my charting. But before I did that, actually, I checked the news. I check on the Barron's, CNBC, five things to know before the market, and it kind of gives me an idea of what the day is like. So when I realized that, I knew that there was data that was going to be dropped at 8:30. And when I then went to do my pre-market charting, because you can see this one in orange here, this is pre-market. But then what then happened when the market opened? The market opens at 9:30 New York time, so I changed my time to New York time, even though I'm in Pacific Standard Time. So when the data was dropped, it really went up, like SPY, it really went up. So what then happened? I trade options. So the options, they are leveraged. They are very risky actually. So I use stop loss like I explained in the video. But essentially, this one move, the price moved from 523 dollars from here, from 523 dollar 72 to around 526 when that data was released, and it was positive because inflation was lower than expected. So usually what I do is I don't like to trade the first 30 minutes in the market when the market opens. I like to trade after 10. You can see that here there was an uptrend. But what I do is I basically want to ride on what big funds do. So I do my charting. I did my charting. I identified that there was a demand zone here because the last red candle here before the big up trend here. So, and then the price started retracing here. So I identified this as my supply zone. And you realize that it usually respects these zones. So what happens is there would be usually a big order block, maybe from a big fund, like let's say Goldman and Sachs at this point, and maybe then there's a sell order at this level, maybe from another big, market maker. Those. So as a retail trader, I just want to move, to just move along with them. If they go this way, I catch this one, I'm out. For options, I will have made some money depending on the number of contracts that I have. So for today, what happened is when I saw this big move, and remember this is a 1 minute candle for SPY, exchange traded fund, and I was trading the options. I realized from what my mentor did teach me from when I took his course. He said when you see this big extended move, what it means is the market usually doesn't like a gap. So there was this big move. Usually, the market, most likely it's going to retrace. So I use the Fibonacci retracement. So that's the one that I use. That Fibonacci retracement candle tool here. So what I did is I traced it, right, and when I traced it, you can see that usually it falls back to the zero point 0.5. It comes back, it gives you potential levels. It's not really guaranteed. So you see that the price, it comes, it respects this level, then it went up, it came, it hit the supply zone, it dropped, it came to this level, it came down, it went up. So when the market opened at 9:30, you see there was a big move. But then I, it's good to continuously update the chart. So when the market opened, it opened at this point, and I had the demand zone here. You can see here this candle, right? So it went up. I didn't take the trade. Usually it's very volatile. So when I noticed that this, I also like to use to check what's really going on the RSI indicator, because usually each time that is there's it's overbought, right? People want to take profits. You can see that when once it exceeds, it goes past this level. Usually, it goes down. So what then happened is, you can see here it dropped, you can see here it dropped, but I kind of use them in syncs, and I also have the volume. So I noticed that it had gone past this level, but also it had touched the supply zone. So what I did is I got into a put. Basically, I was betting that it was going to go down, so I got in a put. I put my tight stop loss, and when it got down, I just made some money when it dropped by this candle, because it's an option, it's leverage. So, and I put my stop loss and I was adjusting it. Uh, and as soon as it started to go back, it hit my stop loss and I took a couple of dollars. So, because today there was a lot of data and there was a lot of Federal Open Market Committee members who were talking, I didn't like to trade. So I was like, you know what? I'm done. So normally I just do that. So you can see that it respected this level and then it ended up going up, and you can see that the price is moving. So this is how I trade. And you can see here, let's say if I was to take a trade, I normally like to take a trade when there is a right setup, right? You can see that here, it seems like there's a supply zone here. And I have done a course, actually, you can see down below, that goes in detail, because I can't really say much here on this short video. But the basics is, you can see that it usually comes here, it goes down, you know and I like to trade within ranges, because here, once it goes out of ranges, then it becomes very tricky, because you don't know where it's going. So I just wanted to quickly illustrate this. So this is essentially how I trade options. Thank you. So hello, and I just wanted to do this quick video on how to swing trade. Basically, like I explained in the video, um, when you're swing trading, you're basically taking a position, like, and holding for a couple of days, whether you are going long, in other words, you're buying low with the expectation that it's going to go up, and or maybe you are betting that, well, from this point, I believe, based on whatever reason, fundamentals or technicals, the price might drop, so you can make the profit as the difference between this minus this selling buying price. If you short, basically you sell at this point and you buy at this point. Basically, you're borrowing the shares from the broker, and then you buy. In other words, you are retaining that, and the profit will be the difference between this sell price and buy price. If you are going short, I don't like to short individual stock or stocks, because at the end of the day, it can go up and then the loss is very unlimited, it's infinite. So what happens is, on TradingView, I just took this chart for Google just as an example when I'm swing trading. So this is for one day, and you can see that is for a couple of months. Here you can see February, and this is May, and this is actually live. And what happens is that you can see that from here, I can see that when I do my charting, I can see like this is a demand zone, right? When it reached this point, 132, that was around March 5th, right? It was a red day, it really dropped, and then it went up, and then this day it closed, right, down, and then it opened, it went up, and then it dropped. But basically the gist of it is, when I am swing trading, I like to get in when really the stock, let's say they miss their earnings and then they really drop, right? Let's say by 10-15%. So for example, you can see here it dropped by this from 176 and then to 162. So this was a big move to the downside. So if I am swing trading, I would say, let's say, buy 100 shares for Google at 162 dollars 61 at this level, and put my stop loss right here to say if I can, if it drops down, maybe I would lose $2 per share. That's 200. But I would be betting that, in a couple of days or a week, if it doesn't hit my stop loss, when it goes up to, let's say, in this case, it goes to 170, right? But you see, it didn't go up in a straight line. It went up and down, up and down. It went down. But if I had put my stop loss here, it would still have gone up, because usually it goes up, along like resistance levels. So if I had then put my sell order here, I would have made my money, or even 70. So that's from, if I had gotten in at $162 here, that's, if and sold at 170, that would be an $8 uh, move. So 8 times 100 shares, that would be $800. So you see that that's how trading, works, because the idea is that you just, like in my case, I like to go long. I buy the shares when they drop, and then uh, at a predetermined price, then I get out. Usually when I get in a swing trade, I put a stop loss to say if it goes down, if it goes up to this level, I get out. But Google, usually it has very strong fundamentals. But when I am investing for the long term, remember, when I'm doing investing, I focus on the fundamentals. I really want to go in when it's really down, right? But if I'm just swing trading, I can still get in when it's down, but I don't really care much about the short term swings, in the sense that if it just drops, maybe by 10% or whatever, and I understand what's really causing the drop and stuff, I can just get in and, buy, let's say, 100 shares. In this case, that would be 16,200, and then sell at whatever point, maybe after $3, or after $5 move, and then automatically it would just sell. If it doesn't go my way, then I put my stop loss when I put the order, then it just kicks me out, but it limits my downside. So I thought I would just share this, because swing trading and day trading, they are different, because you can see here is a daily chart. So this candle tells you what happens in a day, right? It really went up in this day, and then you can see ups and down. It doesn't go up in a straight line. So I thought I would just share this, and thank you so much for watching. If you really want to know more about how to trade options and even stocks, you can check out. I have an online course for how to trade options. But basically, the charting, I do the charting on the stock, because that's where the move happens, and then an option is just the derivative. In other words, it just mimics whatever happens to the stock underlying security. And then options, they are highly leveraged, so they are very risky. You must be aware of that. So thank you so much. I hope you find this helpful.